Yeah, I'm here with Anna Paulson, celebrating your 1 year and 1 month anniversary as president of the Philadelphia Federal Reserve Bank.
That's right, yeah.
And you guys just opened up this Money in Motion exhibit here for the 250th anniversary of the country, or celebration for the country, explaining monetary policy. I hope to go there and understand monetary policy on the backside of it. But let me see if I can understand monetary policy a little better from your perspective about where we're at. Give me your view of the economy right now, especially with regard to the trade-offs that you're thinking about when it comes to the dual mandate of employment versus inflation on the other side.
Right. So this is a complicated time for monetary policy. We've got an economy that's pretty strong, right? We had, second quarter growth came in, and the top line number wasn't so awesome, but when you look at investment and you look at the consumer, it looks really strong. Got a labor market that's stable, and you've got inflation that's too high. So we want to keep the labor market stable and bring inflation down. So that's the primary challenge. And so I think we need, policy that's mildly restrictive. And I think policy has been mildly restrictive to get underlying inflation back down to 2% in an acceptable time period.
How do you judge that policy is mildly restrictive right now? In other words, there are people who say that all of this investment raises the neutral rate. And so maybe you're not as restrictive as you think you are.
And I think that's one of the things that I am assessing constantly. I think that's the key question, right? So I need to see progress from here. And that means, policy needs to be mildly restrictive. So on the one hand, you have, some sectors of the economy, the housing market, for example, that are very subdued. And you have the labor market where, wage growth is very consistent with 2% inflation, right? Low hire, low fire, you're not seeing pressures on inflation in the labor market. And so those things I put in the bucket of, mildly restrictive. The other thing is I hear from price setters, CEOs of big companies, especially ones that are selling directly to consumers, that they don't feel like they can pass along cost increases to consumers because consumers aren't in a position to be able to absorb.
So that helps on the inflation side.
That helps on the inflation side. That's another thing that makes me feel like we're in the mildly restrictive space. But I'm weighing that against, the AI build out and the investment boom. Stock markets have been, pretty robust. So things like that. So I've got to I'm weighing all of the evidence, keeping an open mind about where we're headed from here. So are you wait and
see when it comes to the level of monetary policy now, or are you sort of, it was 9-3. Was it a close call for you at the meeting?
So for me, it was not a close call. I think that, the evidence so far suggests we're in a mildly restrictive stance. Now, there's a couple of things. I just talked about this, weighing the balance between mildly restrictive and not restrictive enough. But the other thing is we've got to see where's underlying inflation, right? We've had, I'm trying to measure the depth of water in a pool, and there's rocks being thrown into the pool, tariffs, energy shocks, things like that. And so, what's the level of the pool? When I look at underlying inflation, when you try to strip out the effects of those things, I see it somewhere in the range of 2.4, 2.8. Maybe there was a little bit of, mild progress over the last several months, but I want to see more progress on that, and that's what I'm really focused on to gauge our progress.
And if you don't see that progress?
I think if we don't see that progress, then we have to be open to recalibrating monetary policy. We need to get to 2%.
And that means higher rates in that sense, right?
Could be higher rates, could be, same rates for longer. We have to, I'm keeping an open mind about what's going to be appropriate.
A lot of people have looked at this and said, it's a supply shock. Let's look through it. So you could call it Superman monetary policy, and that we're just going to look through everything, right, with our X-ray eyes, and we're not going to react to it. But one of your colleagues, Neil Kashkari, said, you know what? There's a role for the Fed to play in addressing supply shocks. What do you think about that?
So I have definitely been of the view that you should look through supply shocks. I think that, the June PC inflation data, kind of validate that, right? We saw there that when we had the lull in the conflict in the Middle East, oil prices came down, we got inflation relief, right? If I had tried to affect that through monetary policy, I would have been, too late. It wouldn't have hit at the right time. So that, that's the logic for looking through supply shocks. Now, you also have to keep, so what I'm looking for is, what's the level in the pool when I can get rid of the shocks, but also, are there any second round effects, right? So that's where monetary policy has a real role to play, to keep those shocks in their lane.
You have a Fed chairman who wants to perhaps suggest some big changes at the Fed. I want to ask you about some of those changes. What do you think about the idea of not providing forward guidance or the reaction function? You just provided us a whole lot of reaction function, which we didn't get from the Fed chairman. What do you think about that idea?
So when you ask about forward guidance, I think forward guidance means something pretty specific. And so it really depends on the economic circumstances, right? So if I'm in the depths of the financial crisis or the COVID crisis, interest rates are at zero, then I can provide more stimulation. I can stimulate the economy by letting investors know, hey, we're going to be at zero for a while. And that's appropriate forward guidance, right? It's dictated by the economic circumstances. If I think about right now, I just told you I've got an open mind about where we go from here. I could do that. So I can't provide any forward guidance about where I'm leaning because I'm weighing the evidence along with everybody else.
But are we better off if we don't hear that from the Fed chairman or from the Federal Reserve? Are we better off with less information or with more information about your thinking?
So I'm sharing my thinking, and I am happy to share my thinking.
Talking talks, I get you. How about going to 6 meetings a year? What do you think about that idea?
I think, so one of the things the chairman has done is, come in with all the task forces, and, I think it's great to take a fresh look at the way we do things, right? And I'm excited about those conversations. I'm excited to consider, what's possible. And so I guess, like monetary policy, I'm open-minded there too. I want to understand better the trade-offs of 6 versus 8, how that all works. But I think it's healthy to have a good discussion about that.
All right, one more in this regard.
Okay.
The dot plot. Do you want to give us your dots? Or you do not want to give us your dots?
All right. So the dots. Sometimes the dots are wonderful. Sometimes the dots are not helpful. I know that when I sit down with my team, and we, think about how we're going to write down our own dots, that is a very healthy discussion because I have to get monetary policy synced up with how I see, inflation going, how I see the labor market going, how I see growth going. And that's a healthy, internal consistency check. So it's a really valuable exercise for me. Now, is it a valuable exercise for markets? Does it help to communicate things? Do people get too obsessed with, the median dot versus the entire constellation of dots? There's 19 people around that table. And, I think sometimes people want to, be reductionist as opposed to wait, what's the breadth of thinking here?
Okay.